silver just hit 60.56 per ounce, shattering every record in 45 years. China exported over 660 tons in October alone, the highest volume ever recorded, draining its vaults to 2015 lows. And just this week, in December 2025, the Fed cut rates by 25 basis points to 3.50, 3.75%, their third consecutive rate cut this year, a move that makes non-yielding assets like silver even more attractive. This isn't just another rally. This is uncharted territory. In 1980, silver hit $50, then crashed 90% within months, bankrupting billionaires. In 2011, it peaked at $49.45, then collapsed 70% over 4 years. Every time silver surged, it ended in disaster. But this time, something's different. The fundamentals have changed. For 4 consecutive years, global demand has exceeded supply, a 149 million ounce deficit in 2024 alone, and the cumulative shortage from 2021 to 2024, 678 million ounces, equivalent to 10 months of global mine production. I'm not a financial advisor. This isn't financial advice. But what's happening in the silver market right now will affect your money whether you own silver or not. So let's figure out exactly what's happening and what comes next. In this video, you will discover why China's Shanghai Futures Exchange inventories hit their lowest level since 2015 and what it means for prices. Bank of America's $65 silver target for 2026 and the data behind their forecast. The Hunt brothers' $1.7 billion mistake in 1980 and why 2025 is fundamentally different. Why industrial demand hit a record 680.5 million ounces in 2024 and it's still growing. How COMEX registered inventory increased from 30 million ounces in 2023 to over 73 million ounces, but why is that still dangerously low? The 3 ways this rally could still blow up and the warning signs to watch. Why the paper silver market at current leverage ratios is a ticking time bomb. And finally, where we are in the 4-stage crisis cycle and what happens next. This is not about getting rich quickly. This is about understanding a structural shortage that's been building for half a decade. Let's start with the history, because this pattern has appeared before, and it never ended well. Our story begins in the 1970s with 3 brothers from Texas, Nelson Bunker Hunt, William Herbert Hunt, and Lamar Hunt. The economy was in chaos. Inflation hit 13.5%. Gas lines stretched for blocks. The Hunt brothers looked at this mess and decided paper money was doomed. They needed silver. In 1973, they started buying at $3 per ounce, but it became an obsession, an attempt to corner the entire global market. By 1979, they controlled over 100 million ounces, roughly 1/3 of the world's supply. Think about that audacity. 3 individuals controlled more silver than most governments. And here's what happened. January 1979, silver at $6. January 1980, silver hits $50, a 713% increase in 12 months. Their paper fortune, billions. Tiffany & Company took out a full-page ad in the New York Times condemning the hoarding. Then regulators stepped in. COMEX enacted Silver Rule 7, restricting new positions. But the real collapse came March 27, 1980, Silver Thursday. The Hunts had used massive leverage to control their positions. As prices fell, they faced margin calls they couldn't meet. On March 27th, they failed to meet a $100 million margin call. The market imploded. In 4 days, silver crashed over 50% from 21 to under 11. The Hunt brothers lost $1.7 billion almost overnight. By 1988, they were convicted of market manipulation, banned from commodities trading for life, and filed for bankruptcy. Silver itself crashed 90% from its peak, falling to $4.90 by 1982. The lesson: manipulation can't last. When the scheme unwinds, it unwinds fast. Fast forward to 2011. The world was reeling from the 2008 financial crisis. The Fed was printing trillions. Inflation fears were rising. Silver went from $30 to $49.45 in just 4 months. This time is different, everyone said. Then on May 1st, 2011, it fell apart. Silver crashed 30% in 5 days, but it didn't stop there. Over the next 4 years, it fell to $14, a 71% decline. If you bought at the top in 2011, you didn't see those prices again until 2024. That's a 13-year wait. The lesson: monetary policy alone isn't enough. If it's mostly speculation without real demand, the collapse is swift. Now 2021, Reddit's Wall Street bets just squeezed GameStop from $20 to $500. They turn to silver next. Silver is the next GME. January 28th, silver at $25. February 1st, silver hits $30. February 8th, back to $26. The squeeze fizzled in days. Why? GameStop had a $2 billion market cap. Silver trades $1.5 trillion annually. It's too big to squeeze through social media coordination alone. So here's the pattern. 1980. Manipulation, 90% crash. 2011. Speculation, 70% crash. 2021. Social media hype, immediate failure. Which brings us to December 2025. Silver at all-time highs. Are we just repeating history? Or is something fundamentally different this time? Here's what's different. For 4 consecutive years, 2021 through 2024, global silver demand has exceeded supply. The 2024 deficit alone, 148.9 million ounces. The cumulative 4-year shortage, 678 million ounces. That's not speculation, that's mathematics. Where did 678 million ounces come from? Existing stockpiles, vaults, and reserves have been built up over decades, and those reserves are running dangerously low. Meanwhile, mine production rose only 0.9% to 819.7 million ounces in 2024. Here's why that matters. About 70% of silver comes as a byproduct of mining copper, zinc, and lead. When base metal prices fall or mines shut down, silver production falls as a side effect. You can't just turn on silver production like a faucet. Opening new mines takes 7 to 10 years. But here's the most important shift, and this is what makes 2025 completely different from 2011. Industrial demand now accounts for over 60% of silver consumption, reaching a record 680.5 million ounces in 2024. In 2011, it was only 50%. This isn't jewelry. This isn't investment speculation. This is the infrastructure of the 21st century economy, and there isn't enough silver to build it. 3 forces are devouring silver faster than it can be produced. First, solar panels. About 20% of global silver demand, 200 million ounces, goes into solar this year alone. China produces over 90% of the world's solar panels, and they're installing them at unprecedented rates. And here's the critical part. Once silver is in a panel, it's effectively gone for 25 to 30 years. It's not economically viable to recycle silver from old panels at current prices. So this demand is cumulative. It keeps building year after year. Second, electric vehicles. Each EV uses 2 to 3 times more silver than a gas car, about 25 to 50 grams in electrical components. Global EV sales are projected to hit 20 million units in 2025. That's hundreds of millions of ounces going into vehicles. Third, AI and data centers. Every new AI training cluster, every 5G tower, every chip fabrication plant requires silver in circuit boards, antennas, and connections. The AI boom isn't just happening on screens, it's happening in data centers packed with silver. This industrial demand is not speculative. It's not going away if sentiment shifts. Solar panels need to be built. EVs need to be manufactured. 5G networks need to be deployed. This is a structural, persistent demand that cannot be easily substituted. Now here's where it gets critical. Remember that export surge I mentioned? In October, China exported over 660 tons of silver. Reports say large shipments were quickly moved to London vaults as traders arbitraged global tightness. Commentators describe this as near-emergency logistics. I've covered commodity markets for years. I've never seen anything like this. When the world's largest financial centers are moving massive quantities of metal across continents in emergency fashion, that's not a bull market, that's a crisis. Shanghai Futures Exchange inventories recently hit their lowest level since 2015. Combined stockpile reductions represent over 40% declines from 2024 peak levels. And here's the signal that matters. The Chinese spot price is now trading at a premium, approximately 60-30 in Shanghai versus 57-58 in New York. That premium means the paper game is breaking. Physical metal is more valuable than paper contracts. When the physical and paper markets diverge like this, it means one thing. There may not be enough real silver to satisfy demand. So let me summarize the core distinction between 2025 and all previous rallies. 1980. Artificial shortage from manipulation, unsustainable. 2011. Speculation without supply shortage is unsustainable. 2021. Social media hype without fundamentals, unsustainable. 2025. Real 4-year structural deficit plus record industrial demand, sustainable but volatile. Now here's where the paper market becomes critical. Right now, COMEX registered inventory stands at over 73 million ounces, which sounds like a lot. But analysts estimate aggregated paper claims, COMEX plus OTC plus other contracts, in the high hundreds of millions of ounces, some estimates near 800 million ounces, versus the current COMEX deliverable stock of 70 to 75 million ounces. This implies a very large multiple of paper claims to physical, though methodologies differ across analysts. Here's what that means. For every physical ounce in COMEX vaults available for delivery, there are multiple paper claims. If even 10% of contract holders demand physical delivery, the system faces serious challenges. They'd have to settle in cash. And when that happens, trust in the paper market evaporates. Industrial users panic because they need silver now, not next quarter. Solar manufacturers' production lines shut down without it. They'll pay massive premiums to secure supply. That's not hype. That's the reality of just-in-time supply chains meeting physical scarcity. This is where institutional positioning becomes fascinating. Bank of America raised its 12-month silver target to $65 per ounce in October 2025, citing narrowed real yields and strengthening ETF inflows. A team led by Michael Widmer wrote that silver's market remains in deficit, even with expected demand declines in some sectors. UBS projects silver around $50 by end of 2025 and $55 by mid-2026. Some analysts, including Peter Krauth speaking at the Metals Investor Forum, suggest $95 isn't out of the question over the next 12 to 24 months based on structural deficits. But here's my perspective. These aren't just bullish cheerleaders. These are major financial institutions with research teams analyzing supply chains, industrial demand, and mine production data. When Bank of America issues a $65 target, they're staking their reputation on it. Now let's talk about where we are in the cycle. Every monetary crisis follows a predictable pattern, which I call the 4-stage framework. Stage 1, stability, low volatility. Mainstream media ignores the asset. Prices range-bound. That was 2020 through early 2024. Stage 2, doubt. Volatility increases. Smart money begins accumulating. First cracks appear. Prices break out of multi-year ranges. That was mid-2024 through early 2025. Stage 3, crisis. This is where we are now. Price breaks above $60, shattering 45-year resistance. Physical shortages are reported in specific markets. Leverage ratios hit danger levels. Mainstream media begins coverage. The evidence. China's record 660-ton October exports, London vault holdings hit multi-year lows earlier in 2025 with hundreds of millions of ounces, although October saw massive flows into London that partly eased localized squeezes. The point, large atypical cross-border movements highlight stress in the physical market. The Fed is cutting rates despite inflation concerns. Stage 4, resolution. Either a controlled reset or disorderly collapse. Historically, this is when holders of physical metal versus paper claims see the massive divergence. We're not there yet, but the pieces are in place. The question is not if we move to stage 4. The question is when and how violent the transition will be. Now, what could derail this scenario? Let me be honest about 3 major risks. Risk 1. Recession kills industrial demand. Remember, 60% of silver demand is industrial. If the economy tanks, solar installations get delayed, EV sales decline, 5G build-outs get postponed. In a deep recession, industrial demand destruction could overwhelm the supply deficit story. We saw this in 2008. Silver crashed from $20 to $9 despite long-term fundamentals. Risk 2. Government intervention. Both 1980 and 2011 ended with regulatory rule changes. If banks holding short positions face stress, regulators will intervene. Additionally, at 60+ per ounce, silver mining becomes extremely profitable. This incentivizes reopening previously uneconomical mines. It takes 2 to 5 years, but if prices stay elevated, supply will respond. Risk 3. You panic. Silver is up 90+% in a year. A 20% correction from here takes us to $48. That wouldn't change the fundamental story, but it would shake out everyone who bought on FOMO. Are you prepared to hold through that? Here's another risk. While the Fed has been cutting rates, they've signaled caution about future cuts. If inflation proves stickier and the Fed has to hold rates higher or even hike again, that could strengthen the dollar and reduce precious metals' appeal temporarily. So why does this matter right now? 3 catalysts are converging. Catalyst 1. The Fed just cut rates to 3.75%, its third rate cut in recent months. Lower rates make non-yielding assets like silver more attractive. If they continue cutting in 2026, as some projects, that's a sustained tailwind for precious metals. Catalyst 2. COMEX registered inventory, while up from 2023 lows, still faces unprecedented open interest. The leverage ratio remains elevated. Any delivery squeeze could trigger rapid price moves. Catalyst 3. China's inventory depletion and record exports suggest they're managing acute tightness. Analyst Zijie Wu suggested the shortage may ease within 2 months. But if it doesn't, the next leg up could be violent. Historically, by the time mainstream media fully covers a commodity shortage, it's too late to buy at reasonable prices. In 2011, silver was $17 in January. By April, it hit $49. That's a 188% gain in 10 months. Those who waited for confirmation paid 188% more. Remember, if you believe the deficit is real and China's vaults are truly depleted, consider your position before potential US tariffs hit and premiums spike further. If you think the shortage is real but maybe not as severe, take a moderate position and watch key signals, lease rates, COMEX inventories, Chinese export data, and government actions. And if you're skeptical, that's fine. Watch the pattern. It doesn't require you to believe in advance, just pay attention when the evidence becomes clearer. Here's my final assessment. Based on everything we've examined, the 4-year cumulative deficit, the record industrial demand, the vault depletions, the institutional positioning, the fundamentals are real this time. 2025 is not 1980 manipulation. It's not 2011 speculation. It's not 2021 social media hype. It's a genuine multi-year structural supply deficit meeting unprecedented industrial demand. The wolf is real. The shortage is real. The industrial demand is real. The vault depletions are real. But real doesn't mean risk-free. Just because fundamentals support higher prices doesn't mean we won't see painful 15 to 20% corrections along the way that shake out weak hands. Markets don't care about your cost basis. Even if silver reaches $75 or $90 by late 2026, the path there will likely include corrections that test conviction. Here's what sets 2025 apart. In 1980, 2011, and 2021, smart money was selling into the hype. In 2025, smart money is dealing with a procurement problem. Industrial companies need silver for their production lines. They can't just wait it out. You can't manufacture 200 million ounces of solar panels if there aren't 200 million ounces available. The laws of physics don't care about sentiment. If you found this analysis valuable, subscribe and turn on notifications. I'll be tracking Shanghai and COMEX inventory levels weekly, bank analyst revisions and institutional positioning, physical premiums and dealer availability, Fed policy signals and their impact on precious metals. Next video. The $75 silver scenario. What happens when industrial users panic buy? I'll break down exactly how a supply squeeze unfolds and the specific price levels to watch. Important disclaimer, this video is for educational and informational purposes only. I am not a licensed financial advisor. All content is my analysis based on publicly available information. Investing in precious metals carries risk, including the risk of total loss. Always do your own research and consult with a qualified financial professional before making any investment decisions. Past performance does not guarantee future results.